Welcome back to Crypto Trading Fundamentals. You understand the basics, but now we tackle the most common point of confusion and the biggest source of both profit and risk: spot trading versus derivatives. We're talking about futures, perpetuals, and the concept of leverage. Leverage warning. This is where the 1% rule becomes non-negotiable. Leverage amplifies both gains and losses. Use this knowledge responsibly. This is for entertainment and education only. Part 1. Spot Trading the Simple Way. When you buy crypto on the spot market, you are buying the actual asset. If you buy one Bitcoin, you own one Bitcoin. You keep it in your wallet, and its value goes up or down with the market. Key feature: spot trading is primarily long only. You buy low and sell high. Your maximum loss is the amount you invested, your principal, and you can only profit when the price goes up. Part 2. Derivatives Trading the Contract. When you trade derivatives like futures or perpetual contracts, you are not buying the coin itself. You are buying a contract that bets on the future price movement of the coin. Key feature 1. Shorting. The derivative market allows you to short an asset. You profit when the price goes down. This lets you trade in any market condition. Key feature 2. Leverage. This is the game changer. Leverage allows you to open a position much larger than your collateral. If you use 10x leverage on a $100 deposit, you can control a $1,000 position. The catch: liquidation. If you use 10x leverage and the price moves against you by just 10%, you lose your entire $100 deposit and your position is liquidated. This is why position sizing is paramount. Understanding perpetual futures. This is the most common crypto derivative. It's essentially a futures contract that never expires. To keep the contract price in line with the spot price, an interest rate called the funding rate is paid. The funding rate is typically paid every 8 hours. If the rate is positive, longs pay shorts. If the rate is negative, shorts pay longs. This is an important consideration for holding positions overnight. The trading adaptation: risk versus leverage. You must calculate your position size based on the stop loss and the liquidation price, ensuring your max risk remains at 1%. Higher leverage means a closer liquidation price, which requires a smaller overall position size. Derivatives offer incredible flexibility, the ability to short and use leverage, but they are an advanced tool. Start with spot trading and only move to derivatives once your risk management is flawless. What level of leverage do you think is appropriate for a beginner crypto derivatives trader? Let us know in the comments. Subscribe as we break down the most powerful crypto chart patterns next.